Please visit www.sensebusiness.co.uk for more useful tips. Sources of finance. All businesses need finance. There are a number of funding sources used by organizations. Why business needs finance. Finance refers to sources of money for a business. Firms need finance to start up a business, pay for premises, new equipment, and advertising, run the business, having enough cash to pay staff wages and supplies on time, expand the business, having funds to pay for a new branch in a different city or country. New businesses find it difficult to raise finance because they usually have just a few customers and many competitors. Lenders are put off by the risk that the startup may fail. If that happens, the owners may be unable to repay borrowed money. Ways to finance a business. Some sources of finance are short term and must be paid back within a year. Other sources of finance are long term and can be paid back over many years. Internal sources of finance are funds found inside the business. For example, profits can be kept back to finance expansion. Alternatively, the business can sell assets, items it owns that are no longer really needed to free up cash. External sources of finance are found outside the business from creditors or banks. Short-term sources of external finance: an overdraft facility where a bank allows a firm to take out more money than it has in its bank account. Trade credits, where suppliers deliver goods now and are willing to wait for a number of days before payment. Factoring, where firms sell their invoices to a factor such as a bank. They do this for some cash right away, rather than waiting 28 days to be paid the full amount. Long-term sources of external finance. Sources of external finance to cover the long term include owners who invest money in the business. For sole traders and partners, this can be their savings. For companies, the funding invested by shareholders is called share capital. Loans from a bank or from family and friends. Hire purchase or leasing, where monthly payments are made for used equipment such as a car. Leased equipment is rented and not owned by the firm. Hired equipment is owned by the firm after the final payment. Creditors and debtors. A creditor is an individual or business that has lent funds to a business and is owed money. A debtor is an individual or a business who has borrowed funds from a business and so owes its money. There is a cost in borrowing funds. Money borrowed from creditors is paid back over time, usually with an additional payment of interest. Interest is the cost of borrowing and the reward for lending. Creditors often ask for security before lending funds. This means sole traders and partners may have to offer their own houses as guarantee that money will be repaid. A company can offer assets, offices as a collateral. The type of finance chosen depends on the type of business. Startup and small firms are considered very high risk and find it difficult to raise external finance. The only source of funds might be the owner's own savings, retained profits, and borrowing from friends. Companies can issue extra shares to raise large amounts of capital in a right issue. We have prepared 10 questions for you to practice. Visit the link below to test yourself. Please visit www.sensebusiness.co.uk for more useful tips.